Welcome to our latest explainer. Today, we're diving into a system-wide shock that really sent a tremor through the entire crypto market. And it all started with a glitch right in the heart of traditional finance. Okay, so let's set the scene. It's 4 in the morning, and in just 24 chaotic hours, a single event is about to trigger a massive cascade of volatility that caught a ton of traders completely by surprise. And here it is. This was the trigger. The CME Group, that's the Chicago Mercantile Exchange, a cornerstone for institutional trading, suddenly just stopped. They suspended all trading. The official line was a system error, but it's the timing of this shutdown that turned a tech issue into a full-blown market crisis.
So you're probably asking, why did a glitch at an old-school institution cause such a massive ripple effect across crypto? Well, it all comes down to one word: liquidity, or in this case, the sudden, terrifying lack of it.
The timing here was just awful, because this shutdown happened right before a huge options expiry event. You can think of this as a massive deadline where billions of dollars in contracts all have to be settled at once. And to do that, you need a ton of cash on hand, liquidity, which is exactly what places like the CME provide. And the scale we're talking about is just staggering. Look at this number, over $15 billion. With a B, all tied up in options for Bitcoin, Ethereum, and other major assets. So yeah, this wasn't just any other Friday. It was a high-stakes settlement day, and the main bank just suddenly closed its doors. And that's the crucial point. With the CME offline, a massive fire hose of institutional cash just vanished into thin air. This created an immediate squeeze, and it set the stage for forced liquidations and the kind of wild, unpredictable price swings that we saw. So let's get into the price action and see how the market actually reacted to this shock, because it was really a tale of two very different cities. Not every asset tanked, and the winners and losers tell a really fascinating story about where we're at right now. So what's pretty interesting is that the two giants, Bitcoin and Ethereum, they held their ground surprisingly well. As you can see, Bitcoin just kind of hung out around that $91,000 mark. But Ethereum, it actually showed some relative strength, probably getting a nice boost from all the optimism around its upcoming Fusaka upgrade. Meanwhile, over in the wild west of the market, the chaos was seen as an opportunity. The meme coin frenzy just kept on rolling, with Turbo absolutely exploding by over 50%. And other fan favorites like Shiba Inu and the DeFi token Athena also posted some really solid gains. But yeah, it wasn't a party for everyone. For some altcoins, it was a total bloodbath. All that volatility and uncertainty sent capital fleeing from assets like Kaspa and Zcash. As you can see, they took a pretty significant hit, dropping hard. Okay, so with prices flying in every direction, let's look past the noise for a second. Let's dig into the key metrics that traders use to really get a pulse on the market's true sentiment. What is the data actually telling us? First up, the classic Fear and Greed Index. It's sitting at 25, which is deep in extreme fear territory. Now that sounds pretty bad, right? But for contrarian investors, extreme fear can often be a signal that it's a good time to buy, precisely because everyone else is panicking. At the same time, let's not forget about Bitcoin's dominance. It's still commanding nearly 58% of the entire crypto market cap. This is a huge reminder that no matter what crazy things happen with individual altcoins, Bitcoin is still in the driver's seat. It dictates where the broader market is headed. And this chart tells a really important story. When a centralized giant like the CME stumbles, where do traders go? They flock to the decentralized world. DEX volume surged, getting super close to its all-time high. And the reason is simple. You can't just shut down a decentralized exchange. So if the everyday traders ran DEXs, what about the big guys, the institutions who actually rely on places like the CME? Where are they moving their capital for safety? Well, the answer reveals a major strategic shift that's happening right now. The real answer, the real alpha, lies in this powerful trend, the convergence of traditional finance, or TradFi, and digital assets. The smart money isn't just speculating anymore. They're building the infrastructure for a whole new financial system. And a massive part of this trend is the rise of stablecoins and these tokenized real-world assets, or RWAs. In simple terms, these are just tokens on a blockchain that are backed by tangible real-world value. And that offers the kind of stability that institutions crave in a market this volatile. And we're seeing hard evidence of this flight to quality everywhere we look. BNY Mellon, one of the oldest banks in the world, just launched a stablecoin reserves fund. Ripple's new stablecoin got the green light in Abu Dhabi. And the number of public companies holding Bitcoin on their balance sheets, it's just exploded. This all fits into a bigger picture that Fidelity Digital Assets has laid out. They see three things happening at once. First, the market's in a volatile acceleration phase. Second, this whole thing is being driven by actual corporate adoption. And third, all of this is going on while regulators are scrambling to provide some much-needed legal clarity. It's really the perfect storm of volatility and institutionalization.
Okay, so let's get to our final section and try to figure out what this all means for the immediate future. After everything that's just happened, what should we be watching for over the next couple of days?
Well, the market is truly balanced on a knife's edge. The landmine is any more bad news from the CME. If there's a delay in fixing their system, it could trigger some real systemic fear. On the flip side, the rocket fuel is the ever-present possibility of positive news about an ETF, which could ignite the next major rally in an instant. So here's the biggest takeaway from this whole chaotic event. The institutional game is changing. For them, that $91,000 Bitcoin price isn't a wall to be broken. It's a trap for over-leveraged traders. While everyone else is fighting on the front lines, the smart money is quietly digging trenches and building fortified positions in stablecoins and real-world assets. And that leaves us with one final provocative thought. With institutions digging into safer assets, what does that mean for the retail investor who's chasing those all-time highs? Is this price level a launchpad for the next leg up, or is it a trap just waiting to be sprung? Thanks for joining this explainer.